You're watching Mirror 7 News. Stay informed, stay ahead for more news.
So here's what's making waves in the business world right now. Couche-Tard, the Canadian convenience store giant based in Laval, has officially pulled its offer to acquire 7&I Holdings, the Japanese parent company of 7-Eleven. After nearly a year of back-and-forth negotiations, this withdrawal might sound like a loss at first glance, but markets are actually celebrating. Let me walk you through what's happening and why this move has sent Couche-Tard's stock soaring. Late Wednesday evening, Couche-Tard's leadership, CEO Alex Miller and founder Alain Bouchard, released a direct and, frankly, pretty scathing letter to the board of 7&I. In it, they accused the Japanese company of a complete lack of constructive engagement. According to Couche-Tard, despite repeated attempts to establish meaningful dialogue, 7&I was uncooperative, slow to act, and unresponsive to proposals, even though the Canadian company had a fully financed, regulation-compliant plan. Now here's where it gets interesting. You'd expect investors to panic, right? Instead, Couche-Tard's stock jumped more than 8% in a single day, closing at $74 on the Toronto Stock Exchange. Why? Because many analysts and investors had been worried about the potential dilution of shares if the acquisition went ahead. Financing such a massive deal might have meant issuing more shares, which would have spread profits thinner among existing shareholders. With the deal off the table, those fears have disappeared. And Couche-Tard isn't just sitting on that money. There's strong speculation, especially from analysts like Michael Van Aelst of TD Securities, that the company will now launch a share buyback program, possibly up to $2.7 billion by April. That's a big deal, because buying back shares reduces the total in circulation, which can boost earnings per share and support the stock price even more. But the story doesn't end there. The failed 7-Eleven bid doesn't mean Couche-Tard is stepping away from expansion. In fact, analysts believe this could open the door for other acquisition targets, especially in the US and Europe. There are reportedly over 40 companies in the US alone that are large enough to move the needle for Couche-Tard's earnings. Still, there's a bit of caution in the air. 7&I could become more aggressive now, especially as they prepare to list their North American operations on the New York Stock Exchange by 2026. That move could heat up the competition for future acquisitions, potentially raising prices and lowering opportunities for Couche-Tard. And on top of all that, Couche-Tard is still facing pressure to strengthen its core operations. Sales at its U.S. convenience stores have been declining for 6 straight quarters, and fuel sales have been down for 7. Consumers are cautious. Inflation is still a factor, and Couche-Tard will need to innovate, particularly in food offerings, to turn things around. So while the 7-Eleven deal is off, this isn't the end of the road. If anything, it's a pivot. Investors are optimistic, the company is flush with cash, and all eyes are on where Couche-Tard will strike next. Stay subscribed for more videos.